Hello traders, welcome back to the Forex Geek channel where we dive deep into the tool that can help you make smarter trading decisions. In today's video, we are going to be talking about the Bladerunner Forex Strategy, a powerful concept that is used with the 20 period exponential moving average to identify the potential market entry points. This strategy is renowned for its precision in cutting through market noise and providing clear signals. Trade with us until the end of this video as we will guide you step by step through this strategy, ensuring you can apply it confidently in your trading endeavors. Now let's look at what this strategy is about. The Blade Runner strategy revolves around one core principle, using the 20 EMA as a line in the sand. When price is above it, we look for buying opportunities, and when price is below it, we look for selling opportunities. As you can see from my chart, price is above the 20 EMA, meaning that we are looking for buying opportunities. When we go over here, we can see that price is below the 20 EMA, and it means we will be looking for selling opportunities in such cases. What makes this strategy particularly effective is its versatility. Whether you are trading the 15 minutes or the daily time frame, the principle remains the same. The strategy works across all major pairs, giving you flexibility in choosing your trading instruments. Now let's check the 1 hour time frame. Let's check time frames and see whether this principle still works. As we can see, when price is trading below the 20 EMA indicator, we can see that on the 1 hour time frame, price is bearish. Then let's look for a bullish scenario. You can see at this area, when price was trading above, it means that price was moving in an uptrend, as the case may be. Let's know how we can trade the Blade Runner's Forex strategy. Let's look at ways we can use in trading this particular strategy. The Blade Runner strategy operates on a simple yet powerful premises. When price reacts from the 20 EMA, it creates specific trading opportunities that we can capitalize on. Now let's look for an example at when price rejects from this level. Let's see whether when price rejects for this level, whether it continues in that particular trending manner. As we can see, price is trading below the 20 EMA, and as you can see, price rejected from the 20 EMA and it continued down. It rejected from this side and it continued going down. Let's see if we can get a bullish opportunity. Okay, as we can see from this area, when price was trading above the 20 EMA, price came to retest the 20 EMA and it continued going up. It retested it at this area, it went up before eventually it switched bearish. So for a bullish trade setup, the market must first show a clear breakout from either a range or establish a strong uptrend. When price trades above the 20 EMA and pulls back to retest that line, that's the 20 EMA, we wait for two specific candles. The first candle is that the candle that touches and closes above the EMA. You will decide from the candle that touch, then the candle that closed. As you can see, this is the first candle that touched it. We'll look for the candle that touched it, then we'll look for the candle that closed above it, and a confirmation candle that continues moving away. As we can see, this candle that closed, if we are not really convinced, we can wait for this one to form, and a candle that closed above and the candle that is moving away, this particular one moving away, before we can take our trade. Then let's look at for a bearish a bearish trade setup when we notice price is trading below. It's actually a similar setup to that of a bullish setup, but in reversal, price must be trading below the 20 EMA with a clear downtrend. As we can see, the market is trending down. From this area, we can see that market is making series of lower lows, lower highs, lower lows, lower highs, lower lows, lower high. As you can see, from the example, I think we should look for a better example to not confuse, so we will not confuse ourselves. Let's make it easier. Okay, this should be a good example. Price is trading below the 20 EMA, making series of lower lows, lower highs, lower lows, lower highs, lower low, lower low, lower highs, lower low, lower highs. So we would first of all make sure that price is trading below the 20 EMA with a clear price direction to the downside. Then we'll look out for price to retrace upward. Price is trading down below the 20 EMA. We wait for price to reject upward to the EMA. When price have gotten to the EMA, we look for a rejection from the EMA levels. So these are the rejections. Price has come back down, and we look for price to close below it. This is an example of price closing below this level, the 20 EMA. How do we enter this trade? We enter the trade by taking our stop loss and putting it at the closed candle. We set our stop loss. We place our protective stop loss above the recent swing high in case of a short trade, and below a recent swing low in case of a long trade, to ensure the stop loss is beyond the EMA level. So because of this is a short trade, we are putting the stop loss above the previous swing lower high. Then our take profit target is at a distance equal to our initial risk. If we are risking 1%, we make sure that our profit should be at least 1:1 or 1:2, as the case may be. We can also set a second target, and it should be placed double the distance, that is 1:2, double the distance of your initial entry to your take profit level, as you can see from the chart here. Now let's not forget market context. For higher probability trades, we look for additional confluences, such as we look for support and resistance level. We make sure that wherever we are trading from, there is actually a support or a resistance level at that area. If you notice here in price here acted as a support for a meantime. Price was reacting from this area, it broke the line, came up, it was reacting from this area. You can see before finally price came to this area, showing that this is actually a resistance area, a support that turned a resistance area. So this is the market context. You first of all make sure you are trading from a support or a resistance level. You can also make sure you are trading from a pivot point, or you can make sure that you are trading from a round number. These are areas that you know that market respect. They are called psychological numbers, like psychological levels in the market. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, share and subscribe. Turn on the notification bell so that you will not miss out on any trading tip or strategy. Thank you for watching, and I will see you in the next video. Good luck.